Hi, and welcome back to Investment Banking University's Investment Banking course. And we're talking about the first side of the perpetuity, the build side. And within that, we're now talking about perpetuity management. On the build side, we're ultimately concerned with the creation and management of perpetuities. We first explore the perpetuity analysis methodology that we went through. And now we've talked about in the past as well, perpetuity building process and timeline. And now we're moving towards a methodology for perpetuity management. So in terms of perpetuity management, the purpose of the company, of course, is to create, companies exist to create value. Companies create value by investing capital at rates of return that exceed their cost of capital. This is the principle of value creation. The only thing that differs across companies is the implementation, i.e. the different assets and capitalization mix. So in terms of strategy and finance, we can think of these coming together at the perpetuity. In terms of strategy, we have the rate of return, or IRR, and the corresponding side to that in terms of finance is cost of capital. In terms of asset mix on the strategy side, we have the corresponding finance side, capitalization mix. In terms of corporate strategy, we have finance and then uses and sources matched together. So we ultimately get into the discussion of valuation drivers when talking about perpetuity management and the role of the CEO, which we've already discussed. The perpetuity management process is something that we're going to get into in just a little bit. So we have to consider whether or not we're going to be doing growth or restructuring as to whether or not we're hitting our growth targets in terms of our cash flow and EPS performance assessment through time. So if we have hit our growth target, we're going to continue to grow. If we missed our growth target, we're going to have to assess perpetuity analysis and then ultimately decide to restructure. So in terms of measuring value added, we're going to be talking about ROIC versus market return, or return on invested capital versus market return. Measuring return on invested capital after tax operating profits divided by capital invested in working capital and PP&E, and then we're going to compare this with stock market returns. In terms of measuring value added, in another metric, which is economic profit and NPV, economic profit is equal to the ROIC spread percentage over the cost of capital times invested capital. And we're going to get into a little bit later. But the objective is to maximize economic profit. When the company is larger, one should use NPV, which calculates economic profit in a more robust and flexible fashion. In terms of valuation in public markets, valuation in public markets has investors paying for the performance they expect the company to achieve in the future, i.e. investors ultimately end up paying for more since their valuations are based upon not the past, not based upon the past or the cost of the assets. The CEO ultimately endeavors to have his company in the public markets since the largest multiples are applied in valuation. And we're talking about the public markets, and really when we think in terms of the public markets, we're thinking in terms of a growing perpetuity or a diversified perpetuity, and we have seen that in where those multiples are on the previous chart, the market for perpetuities. So in terms of the real markets and financial markets, when there's a public company, the CEO has to both maximize the intrinsic DCF value of a company and manage the expectations of the financial market. Differences between the actual performance and market expectations and changes in these expectations drive share prices. The delivery of surprises produce higher or lower total shareholder returns. So in terms of perpetuity planning and control, i.e. management, planning and control systems should be put in place to monitor the NPV of every business unit and then sum those NPVs to the corporation. Economic profit, i.e. NPV, targets set annually for the next 3 years, have targets set annually through the next 3 years, and then progress is monitored monthly, and managers' compensation is tied to economic profit against these targets. In terms of value metrics, metrics are to drive decisions and guide all employees towards value creation. So in terms of perpetuity planning and control, in practice, corporate management sets long-term value creation targets in terms of market value of the company or total share returns to shareholders, TRS. Strategic alternatives are valued in terms of DCF, i.e. NPV, and intrinsic value of chosen strategic alternatives are translated into short-term and medium-term financial targets, and then targets for operating and strategic value drivers are determined. Performance is assessed by comparing results with targets on both financial indicators and key value drivers. So managerial rewards are ultimately linked to performance on financial measures and key value drivers. Continuing on value metrics, we're talking now about market value added and total return to shareholders. So market value added is the difference between the market value of a company's debt and equity and the amount of invested capital. It measures financial markets' view of future performance relative to capital invested in the business. So total return to shareholders measure performance against the expectations of financial markets, and changes in these expectations is ultimately what they're getting at. TRS measures how a company betas the target set by market expectation, or beats actually. So TRS measures how well a company beats the targets set by the market expectations. In terms of DCF versus earnings multiples, DCF speaking in terms of intrinsic value versus earnings multiples, which is a market value in terms of valuation. So DCF is intrinsic value, earnings multiples are market values. And we as investment bankers really have to know the difference between these two. Earnings alone is inadequate without understanding the investment required to generate the earnings. One should know ROIC. So in terms of cash flow equals the operating profits of the company less the net investment in working capital and fixed assets to support the company's growth. In terms of a perpetuity management capability, we're ultimately going to be analyzing where the perpetuity is currently at, which phase, determine which phase is the goal to get to. Oftentimes it's going to be a public company. So that's either going to be the phase is either going to be a growing perpetuity or a diversified perpetuity. Determine the steps to get to that next phase of the perpetuity. And then we're going to be building a work breakdown structure to get to the next phase, working backwards from that next phase towards where we are currently. And then ultimately we're going to help and aid in the execution of that plan if we're the CEO or a consultant, be it an investment banker or a different type of consultant. So we've already talked about the perpetuity lifestyle, which corresponds with different phases of the perpetuity. And so in the next video, we're actually going to get into evaluation methodologies.